Hi there, everyone. It's Ifti from Extreme Returns. Here's a question for you. If you've got two funds, one that delivers 10% per year and the other one that delivered 20% per year, which one would you choose? Most people would choose 20%, but that might not be the right answer. What we have to do is look at risk-adjusted returns. And there's the most common ratio that's used to assess risk is called the Sharpe ratio. And that's what we're going to look at today. So without further ado, my name's 𝙋𝙧𝙤𝙤𝙤𝙤. You can call me Ifti. I am by background a chartered management accountant. I've worked for Unilever and Mars. I've been into recruitment consultancy and headhunting. I've become an entrepreneur as well. I've set up a very successful estate agency. And most recently, I have been doing peer-to-peer car hire on Etoro and also 𝙀𝙀𝙤𝙤𝙤𝙤. I've got a channel. Please do subscribe. It would really help. Got 93 at the moment. And if you type in Ifti my story, you'll come across this cool cartoon I've made. I've been featured on the BBC, The Independent, all different types of media outlets. I joined Extreme Returns on Etoro. It's only been going a few months. Funnily enough, in January, it was up by nearly 15%. In February, it was well over 15%. Markets are dipped. We're on the 1st of March, halfway through the US session, and we're doing not too bad. Look at that, 4.2%. Not bad at all. Okay, so let's go back to this. So the question I have is, how do you know which fund to invest in? So there was a very clever chap called William Sharpe, 1966, he later became a Nobel laureate, and he looked at this in a lot of detail. So the mystery is this. Are the higher returns due to the skill of choosing the best stocks, or is it gambling and luck? Was the high returns due to a raging bull market? So how do you know? That's the mystery we're trying to solve today. So you see lots of funds. First of all, we all look at the absolute return. The absolute return is the amount that the fund has increased by. But there should be, and usually are, alarm bells going on inside our heads. And we're thinking, is this too good to be true? It's going up and up and up. It could easily fall off the edge of a cliff. How do we know? Is there danger ahead? So here's the question again. Choose A or B. Fund A has 10% return. Fund B has 20% return. Those aren't minuses, by the way. Most people would choose Fund B. Now, let me ask you another question. If Fund A, if you could find out, if there was a magic way of finding out, Fund A has only a 5% chance of losing you money, or a 95% chance of not losing you money. But Fund B has an 80% chance of losing you money. Now, which one would you choose? Most people would choose Fund A, although the returns are less. It's all about the risk. And here, the other magic word I'd use is it sustainable? Or like this chap, is it all going to come crashing down? So this clever chap called William Sharpe came up with a ratio. Now, I'm not going to go into too much detail, but very briefly, you take the absolute return, compound annual growth rate, minus what's called the risk-free rate. Now, what that means is if you had some investments which were totally free of any risk, you take the absolute minus the risk-free return. Now, for most people, we use the treasury bills in America because we know the American government is unlikely to go bust. So if you lend the money, the chances are you'll get your money back. Those are the treasury bills. And then you divide it by the annual risk, which is a standard deviation. So let's give you an example. If the absolute return was 13% and the risk-free rate we're just making up numbers here, was 1%, you take 13 minus 1. If the standard deviation was 12%, then 12 divided by 12 is 1. What does that mean? Well, anything 1 or above means that it's good. Anything below 0 means it's bad. Anything below 0 means you might as well take the treasury bills or the risk-free return which you could invest in. Now, the higher generally the Sharpe ratio is, the better. So let's look at some examples. The S&P 500 has been given 0.96 and the NASDAQ 100 not too far behind at 0.95. If you were to subscribe to more some of the sites like Morningstar, here we go here. I haven't subscribed to this one at the moment, but what you can do is go into any ETF. Here's the S&P 500, SPY, and here they would display it. So you can look at the Sharpe ratio of all the funds. Now, it's all about probability. We know from history there will always be a bull market. The definition of a bull market is the prices of the stocks are increasing. And we know there will always be some, from time to time, a bear market. And the definition of a bear market is 20% reduction from the all-time highs. But, and here's the problem, no one knows when we'll enter a bull market or when we'll enter a bear market. Nobody can tell that. Not even the best, most experienced fund managers. So it's a game of probability. How do you know when the bull market will come about or the bear market will come about? So William Sharpe came up with this formula, and it's a ratio. However, now that we know that this is one of the most commonly held ways of looking risk-adjusted returns, there are downsides to this. Let me just say that nearly every fund manager looks at the Sharpe ratio. Sometimes they look at that before they look at the absolute returns, believe it or not. So here are some of the problems or downsides with the Sharpe ratio. First of all, it treats gains and losses in the same way. It's a mathematical formula, because whether the gain or the loss, whether it's a gain or a loss, it's deviating from the mean. Clearly, a gain is very different to a loss, and some people think it should be treated in a different way. And we're going to come on to one of those ratios later. Secondly, the Sharpe ratio, being a mathematical formula, assumes returns are normally distributed. Now, a normal distribution is like rolling a dice. And over many rolls, we know that the most common is 7 and the least common is 12 and 2. But financial markets are not normally distributed in mathematical terms. In fact, they're skewed away from the average because of volatility. It's a very different distribution. What that means is that the Sharpe ratio is not perfect. And a lot of fund managers, believe it or not, manipulate the Sharpe ratio by changing the length of time. Now, obviously, the Sharpe ratio will change whether it's a daily return or a weekly return or a monthly return or an annual return or even longer. Nobody has yet come up with what is the ideal time frame. So what some people have done is that they've looked at alternatives. And here are some of the alternatives which I've covered in a separate video. Sortino ratio, the Traynor, and the ULSA. Some of them, the ULSA ratio has got a fantastic name. And I'll be covering that I've covered that already in a different video. So I hope you found it useful. This has been Ifty from Extreme Returns on the Etoro platform, looking at risk-adjusted returns and the Sharpe ratio in particular. Thank you very much, guys. Take care and see you guys soon.